Welcome to the deep dive. Today, we're not just looking at an earnings report, we're really examining the blueprint for what might be the world's largest AI factory.
That's a great way to put it.
Microsoft's fiscal Q1 2026 earnings were astronomical, far exceeding expectations. But the real mystery we're solving is this. Are these results the beginning of a massive, profitable pivot, or are they a temporary spike driven by, unsustainable capital expenditure?
Exactly. That's the core tension. The numbers were undeniably strong, signaling a fundamental shift. So our mission today is to really analyze the earnings call, the reports, and understand the sheer scale of this investment.
And the growth of the Copilot plan.
And the growth, yes. But critically, we also need to look at the severe strategic challenges they're already facing. I'm talking about supply chains, capacity constraints, and this rising specter of customer concentration risk.
Let's start with that sheer scale then. Total revenue hit $77.7 billion, up 18% year over year.
Which is incredible on its own.
It is. But you have to isolate the engine of that growth. Microsoft Cloud revenues surged to $49.1 billion, growing 26%. That kind of movement isn't just interest, it's a mass migration to their platform.
It absolutely sets the stage. But before we get drawn into the dizzying details of where all this growth is coming from, and maybe more importantly, where this tidal wave of cash is going, we need to say something.
Yes, the mandatory part.
We here at the Deep Dive need to remind you, the listener, that all information and analysis discussed is purely for understanding the market and is not investment advice.
Investing carries risks.
Always. So please, always conduct your own research or consult a professional financial advisor before making any decisions.
Duly noted. Okay, let's dive straight into the money. Or, well, maybe the lack of it if you just look at their official accounting. The partnership with OpenAI is the single biggest factor distorting the financials right now.
It's huge. We learned they've roughly 10x'd their initial investment, and OpenAI has already contracted for an incremental $250 billion in Azure services.
$250 billion.
That gargantuan commitment is what forces us to look beyond the top-line revenue and really scrutinize the actual profit numbers. The sheer size of this deal means the financial statements look messy.
So we have to talk about GAAP versus non-GAAP results.
We have to. It's critical here.
This is where it can get dense for listeners. Can you lay out the difference for us simply?
Of course. So the reported non-GAAP diluted earnings per share was $4.13, up 23%. That's the number the street generally watches.
Because it tells you how healthy the core business is.
Exactly. But the GAAP net income, that's the legally required accounting figure, was heavily impacted by substantial losses from the OpenAI investment. We're talking $3.1 billion just for the quarter.
Okay, so if they're reporting a $3.1 billion hit on the GAAP books, why should we trust the clean, higher non-GAAP number?
That's the most important question. The non-GAAP adjustment is basically telling the market, if you ignore this massive one-time strategic loss we are intentionally taking to finance our AI pivot, the underlying cloud business.
Azure, M365, all of that.
All of it, yes. It's not only wildly profitable, but it's accelerating its profitability. It proves the core engine is strong enough to swallow these massive capital deployment costs without the operational performance suffering.
Understood. It's the price of admission to the AI race. Now, let's look forward. The commercial strength isn't just today's revenue. It's tomorrow's guaranteed revenue, which brings us to the RPO.
The commercial remaining performance obligation.
And that RPO increased a stunning 51% to nearly $400 billion.
Just think of RPO as the contractual backlog. It's money that's already locked in the vault, services they are obligated to deliver because the customer has already signed.
It's at a jump 51% to $400 billion. That's not just a bookings blowout.
No, it's a historic vote of confidence from the global enterprise sector.
But what I find fascinating, and maybe a little alarming, is the commitment duration. The weighted average duration of those contracts stayed stable at around 2 years. For $400 billion, that sounds like a very short time horizon.
It is a short fuse. It tells you that customers aren't signing passive 5-year legacy licenses that might just sit on a shelf.
Right.
They are signing contracts with a clear intention of consuming this massive compute and service commitment quickly. It suggests a high-conviction, high-speed rollout of AI across the entire global enterprise. They're buying the tickets because the show is starting now.
Okay, so let's unpack exactly what they're buying, because it points directly to productivity. We heard that 900 million monthly active users are engaging with AI features across their products.
And the first-party family of Copilots alone has now hit 150 million MAUs. This isn't just about general AI. It's about targeted, high-value application in specific domains.
And that brings us directly to a concept that was all over the earnings call, agentic AI.
And agentic transformation, yes. Before we get to the anecdotes, we really need to define that term because it's critical to understanding the value proposition.
Go for it. And maybe avoid the textbook definition if you can.
I'll try. So agentic AI is moving beyond simple generation, where you type a prompt and the AI gives you an answer.
Okay.
Agentic AI is the capability to assign the AI a multi-step complex goal, like draft a full market analysis for our new product line in this specific geography and integrate it into a PowerPoint presentation. The AI becomes an agent.
An agent that executes and iterates on the tasks until you get an expert quality outcome.
Precisely. It's goal achievement, not just text generation.
That distinction changes everything. It means Copilot is no longer just a helper. It's a virtual junior employee.
Exactly. And that's why the real-world metrics are so potent. Microsoft 365 Copilot is being adopted faster than any other M365 suite in their history.
And we saw tangible proof in the anecdotes. Over 90% of the Fortune 500 now use it, but the specifics are what's really telling.
Give us the big one.
Lloyd's Banking Group. They deployed 30,000 seats and reported saving each employee an average of 46 minutes daily.
46 minutes a day. If you annualize that across 30,000 people, that represents millions of hours reclaimed for higher value work.
And then there's PwC, which added a staggering 155,000 seats, and they explicitly credited this agentic transformation with saving millions of employee hours globally. This isn't hype, it's measurable productivity.
And that goal achievement capability is clearly extending to developers, too. GitHub Copilot has 26 million users.
And 80% of new developers start using it within their first week. That shows it's now seen as a standard tool, not some optional novelty.
They're even building infrastructure to manage this new reality with something called Agent HQ, which is designed to manage coding agents from various vendors, Google, XAI, OpenAI, you name it.
The success of Copilot, whether it's for coding or information work, it begs the question, what engine is running this massive new fleet? And that brings us to the underlying platform.
Azure. Azure revenue growth hit 40%, 39% in constant currency.
That's a powerful number on its own, but how are they making sure this engine serves everyone, not just their biggest partners?
Well, they're running the Azure AI Foundry, which serves 80,000 customers right now, including 80% of the Fortune 500, and it offers access to over 11,000 different models.
So it's an open ecosystem.
Very much so. But what's fascinating is their first-party success, which shows they aren't relying solely on OpenAI. Their 5 family of small language models, SLMs, has been downloaded over 60 million times. That's a 3-fold increase year over year.
Wow.
They are strategically covering the whole ecosystem.
And it shows that the entire enterprise cloud ecosystem is surging, not just the AI accelerator market. We saw other segments perform strongly too. Fabric, their data and analytics platform, grew 60%.
And Dynamics 365 grew 18%. This unified commercial strength means the demand for resources is just immense.
And that demand introduces the critical challenge of this entire earnings cycle, the capacity conundrum.
Yes. They explicitly stated that demand for Azure AI services exceeded supply, even with huge capacity additions coming online. They're effectively hitting a capacity wall.
This directly correlates with their colossal capital expenditure, $34.9 billion for the quarter. To the average listener, that just sounds reckless. How do they justify that?
That's where the strategic brilliance of the spend breakdown comes in and why it's not reckless, but a really calculated hedge. The TypeX wasn't monolithic. They split the investment almost exactly in half.
Half for what?
Roughly half was spent on short-lived assets, so that's the GPUs and CPUs themselves. These assets have a short depreciation cycle, and it usually matches the shorter duration of the AI contracts and that RPO we just discussed.
So that's the immediate gear needed to monetize the next 2 years of contracted revenue.
You got it. The other half was spent on long-lived assets, data center sites, land, the physical structures. These assets support monetization for 15 years or more.
So if the customer commitment, the RPO, is short-term but massive, they are hedging that with short-lived gear to service it, while using the long-lived structures to guarantee they can capture revenue from that infrastructure for a decade and a half.
Precisely. It's a perfectly hedged bet. They have extreme confidence in the long-term utility of the physical footprint. And the commitment to solve this gap is historic. AI capacity will increase by over 80% this year.
And their total data center footprint will roughly double over the next 2 years.
And crucially, they now expect to be capacity constrained through at least the end of the fiscal year.
Which means they have demand locked in that they literally cannot service yet.
Yeah.
It's a good problem to have, maybe, but it points to risk.
It does.
And that risk brings up the elephant in the room, concentration risk. If one partner, OpenAI, is contracting for $250 billion in services, isn't Microsoft holding all their chips in one giant basket? Aren't they already failing to mitigate that?
That's the tension Satya Nadella had to address directly. And while the OpenAI contract is massive, the company is managing this risk by focusing on building a fungible fleet.
A fungible fleet.
Yeah. The goal is not to have data centers dedicated only to one customer or one type of workload. The fleet has to be globally adaptable or fungible for everything: pre-training, inference, first-party use for Copilot, and third-party enterprise customers.
And what does that fungibility buy them?
Flexibility and margin control. They acknowledge they have to balance third-party demand like from those AI natives who just want raw compute with their own first-party needs for Copilot and R&D.
So to maintain a strong margin stack, they have to be selective.
They're being very selective.
You mean they were turning down business?
They are actively saying no to some of the demand that is too concentrated or focused only on a single meter, like just AI accelerators.
Because that doesn't drive usage across their entire profitable stack storage networking platform services.
Exactly. They are strategically managing growth to protect the margin and ensure that infrastructure remains available to the broad enterprise base that drives their stable long-term revenue.
This strategic management is clearly crucial to their near-term outlook. So what do they project for Q2, knowing this capacity crunch will continue?
For Q2, they guided for total revenue between $79.5 and $80.6 billion. That's about 14 to 16% growth overall. Azure growth is expected at approximately 37% in constant currency.
And they reiterated that demand is still ahead of capacity.
Significantly ahead, yes. Confirming this constraint isn't going away overnight. M365 commercial cloud growth is expected at 13 to 14%, driven largely by increasing average revenue per user, or ARPU, from customers upgrading and adding Copilot.
Okay, here is where it gets really interesting for me. The philosophical underpinning of their strategy. When asked if the eventual arrival of true AGI might neutralize Microsoft's market advantage, the CEO offered a fascinating perspective on what AI will look like for the foreseeable future.
He introduced the concept of jagged intelligence, or spiky intelligence.
Right.
The core insight is that even as AI models become exponentially more powerful, GPT-5, GPT-6, whatever's next, their capabilities will remain uneven. They'll be amazing at some tasks, but still prone to mistakes, hallucinations, or lack of context in others.
So they won't be uniformly perfect AGI anytime soon.
Not at all.
So the models are inherently jagged. What does that mean for Microsoft's strategic moat?
It means that you need a system, an organizing layer, to smooth out those jagged edges and deploy that incredible spiky capability reliably in the real world. That organizing layer, the Copilot systems, the agent HQs, the integration into Outlook and Excel becomes the essential interface.
So the value shifts from the raw foundational model itself to the system that integrates and harnesses that power reliably within the enterprise workflow.
That's the whole play. So even if the underlying model is magical, if it's uneven, it needs Microsoft's robust, secure systems to make it practically useful in, say, auditing or banking or logistics. That system is the lasting value.
That's the synthesis. They're managing massive demand, validated by that $400 billion RPO, making enormous, confident capital bets in infrastructure.
But their ultimate strategic differentiator is building the entire stack, the Copilot system and the Foundry. That ensures they are the indispensable gatekeepers who smooth the integration of these cutting-edge but still uneven AI models into enterprise reality. They are not just selling compute, they're selling reliable capability.
This deep dive has shown that Microsoft isn't just growing, it's strategically restructuring its entire operating model around AI. So for you, the listener, what are the 3 biggest takeaways we covered today?
Okay, first, AI is absolutely accelerating the top line. That's evidenced by the RPO explosion and the enduring 40% growth in Azure.
Second, the investment in Copilot is now yielding measurable, tangible, real-world productivity gains seen in the metrics from companies like PwC and Lloyd's.
And third, their strategic focus is centered on building a fungible, hyper-efficient AI factory, while, at the same time, managing customer concentration risk and selective demand to maintain profitability and strategic flexibility.
All right, and for a final provocative thought.
For you to consider, if the next decade is defined by this jagged intelligence rather than instant, uniform AGI, how much enduring value does the organizing layer, the system Microsoft is so aggressively building, actually hold compared to the underlying foundational models themselves?
Something to think about.
And remember, we here at the Deep Dive have only provided analysis to help you understand the market. This is not investment advice. Investing carries risk, so be sure to consult with a professional advisor.
VNS.